Good morning friends, welcome to the point. In today's video we will discuss about a segment of money market that is called call money market, which is often used by the banks to meet their overnight liquidity problems. So we'll start with what money market is. So according to RBI, the money market is center for dealing mainly of short character in monetary assets. It meets the short-term requirements of borrowers and provide liquidity or cash to the lenders. So whenever the borrower wants to meet some short-term requirement of cash, so the market that it approaches is the money market, and of that money market there's a segment called call money market. So whenever the banks is in need of money for overnight purpose, that is for 24 hours or say overnight or one day purpose, then the segment that it approaches is the call money market. The call money market is the market where overnight loans can be availed by the banks to meet the liquidity. So banks often have to maintain certain liquidity ratios like CRR, that is cash reserve ratio, or SLR, that is statutory liquidity ratio. So whenever banks fall short of money, so the market that it approaches to fulfill the need for 24 hours, it is known as call money market. So banks who seeks to avail liquidity approaches the call market as borrowers, and the ones who have excess liquidity participate there as lenders. So any bank can participate in the call money market. So those banks who wants the money would approach the market as borrower as they want the money, and there would be certainly some banks that would be having excessive cash, so they can approach the market and can lend the money for overnight purpose and would participate as lenders of the money. Moving on to the slide which talks about the features as well as functioning of call money market as to how does it function. So first feature is that it deals with day-to-day cash requirement of bank. Yes, obviously, because in case if the cash requirement is for the long-term purpose, then the money market is not the place for the banks to go for. It is only when they need money for the short-term purpose and especially for overnight purpose, then they approach the call money market. Now what if the bank needs money for more than one day but less than 14 days? So this is an extra information that I am giving you, that when the bank needs money for more than one day but less than 14 days, then it approaches notice money market. Now the third feature is the rate at which these transactions takes place. The second point, loans are availed through auction negotiation. The auction is made on interest rate. Highest bidder who is ready to give highest or higher interest rate can avail the loan. So for example, there are some lenders and here are the borrowers. So whichever borrower, let's suppose there are 4 borrowers by the name of A, B, C and D. Now all 4 of them are borrowers and there is 100 crore in the market, whereas the demand is more, that is let's suppose 150 crore. So every bidder would try to offer the higher interest rate so as to get the maximum out of this 100 crore, because the supply is limited and demand is more. So every bank would want that they should get the money, and in order to attract the lender, they would offer the higher interest rate as compared to the rate offered by the fellow borrowers or the competitive borrowers. So whosoever is quoting the highest rate of interest for one day will get the money, as simple as that, which is the rule of auction. The rate at which this transaction takes place is known as call rate. So the rate at which the deal is finalized between the lender and the borrower is known as call rate. Fourth point is the funds lent in call money market are unsecured in nature, which means there is no collateral security provided by the borrower to the lender for overnight purpose. It is an unsecured natured loan that is provided by the lender to the borrower in call money market. Fifth point, the dealing in call money is done through electronic trading platform called negotiated trading system. So all this dealing between the lender and borrower, that is the auction and the paying of interest and the money back, takes place through negotiated trading system. And sixth point is this call money rate is an important variable for the RBI to assess the liquidity situation in the economy. And how it is possible for RBI to assess the liquidity situation through call money market is, let's suppose if there are more and more number of bank that is approaching the call money market, so by this RBI gauges that there is liquidity crunch in the market. That is why the banks are coming to the call money market to fulfill their liquidity needs. In opposite to this, if there are a very less number of banks or no banks that is approaching call money market for the liquidity requirement, so RBI could assess the situation that there is enough or sufficient liquidity in the market. That is why the banks are not coming to the market, and they are automatically, or they are self-sufficient in maintaining the liquidity ratios or the cash crunch. So by this, RBI is able to gauge the liquidity situation in the economy. Moving on to the next and the last one for the day, talks about the participants of the call money market. So it talks or tells about as to which all banks can participate both as the borrowers and the lenders. So they are scheduled commercial banks, payment banks, small finance bank, regional rural banks, state cooperative banks, district cooperative banks, and the urban cooperative banks. So in overall, if we talk or say, that is the cooperative banks are also allowed to participate in the market both as the lender, that is they can borrow the money as well as they can lend the money in this market. So friends, this was all with respect to the call money market which we were supposed to cover, and we have covered the broad aspects of call money market. So this is all for the today's video. Thank you for your patience.